Good morning, Canberra, for Cam's Mortgage Minute on Friday, January 25th. Hey, you've always heard, or if you've gone to school at any point, you must have heard of Newton's laws of physics, and one of them was that for every action, there's an equal and opposite reaction. Now, the reason this came to mind for me was when I saw Equifax's latest national credits trend study. And basically what it did is it compares Equifax, as you know, as a credit reporting agency that looks at overall debt. And they found that in the fourth quarter of 2012, there was a 3.2% increase, basically a rise in non-mortgage loans compared to a year ago at the same period. And so that is over and above the nearly 2% climb recorded between July and September, again, a year-over-year comparison. Now, the new debt comes in the form of basically bank loans, lines of credit, car leases, credit cards, all those different things. And for those of you who might not know, they typically will carry a higher debt, basically interest rate than a mortgage would per se, and typically by at least 2% almost. The growth starting in Q3 of this increased debt also, funny enough, coincides with the government's latest round of mortgage rule changes, which reduced the ceiling on refinances to 80% loan to value from 85% loan to value. So basically what this meant is that if you had a house that was worth $500,000, now you can only refinance it for up to a maximum of $400,000. In the past, you could have financed that same house for $425,000, so you had a little bit of extra wiggle room. Now, some of you might be saying, hey, that's fantastic, that's great, we don't want people taking equity out of their homes, they shouldn't be. And I agree with you, I mean, those things make a lot of sense. But when we start seeing this kind of rise in basically unsecured lending, that also has a dramatic effect because there's, again, payments that have to be made for all those sorts of things too. So are we starting to see the chickens come to roost? Well, we're going to find out what happens. There was a little bit of good news in this, even though that households do have debt levels and everything else, and since the more stringent rules have been introduced, the percentage of unpaid non-mortgage debt arrears are more than 90 days past due stood at 1.19%. On the fourth quarter, down slightly from 1.22% in Q3 of last year. So that's good news. It means that delinquencies are certainly not on the rise. There seems to be debt levels. In that sense, people are making the payments even though they're borrowing money. So again, one of those things that we'll have to look long term to see what the impact is. With the government having made that change, are people truly dipping into other ways to try to finance things? Are they refinancing using credit lines and, like we said, all those other things? Or is it just simply people who have decided they're not going to pull equity out of their houses, they would rather just have increased debt in some other form and leave the equity in their home alone? Again, time will tell. With so many of these things in the economy, it's very hard to predict because none of us have a crystal ball. We can only look at what's been reported in the past and see how that's going to affect us going forward. But again, interesting numbers out of Equifax, which would certainly support what a lot of mortgage brokers said when the new rules were introduced, the fact that borrowers would turn to other sources other than their home, and those debt levels would increase. Again, will this trend hold for the future? We'll see in the end of basically the first quarter of 2013 going forward. Anyways, it's been Cam for Cam's Mortgage Minute. Enjoy your day and enjoy your weekend, and I will see you on Monday.